For decades, we've all been taught to measure our financial lives by one big number, net worth. But what if that single number is actually giving us a dangerously incomplete picture? Today, we're going to explore a more dynamic and, frankly, a more predictive way to understand your financial progress. Let's start by digging into the core problem.
We're kind of conditioned to see it as the final score, right? The higher the number, the better you're doing. But this reliance on just one static figure can be really misleading. Sure, it tells you where you are right now, but it gives you almost no information about where you're actually headed.
And this idea right here is the key to shifting our entire perspective. It suggests that maybe our focus has been on the wrong indicator all along. It means we have to look beyond the simple balance sheet to really understand what's building wealth. Okay, so first, let's break down why this one number has such a powerful hold on us. Well, it's simple. It's easy to compare, and in a world of really complex finance, it feels solid. So it just kind of quietly becomes the scoreboard we use to measure ourselves against everyone else. A number feels certain, doesn't it? But without understanding the forces that actually created it, it's just a data point. It doesn't capture your momentum, your habits, or the systems that are either working for you or against you right under the surface. And this brings us to the biggest analytical issue with net worth. It's a snapshot in time. You can think of it like a single photo from a very long journey. It captures one moment perfectly, but it completely misses the motion. Let's use the median household net worth in the US as an example. So on the surface, $193,000 seems like a pretty solid figure, but let's actually look at what's inside that number. So when you take a closer look at the data, you start to see how much of that median net worth isn't actually productive. About half of it is tied up in home equity, which is often illiquid. Another big chunk, 20%, is in stuff that's losing value, like cars. That means only about 30% is in financial assets that are actively compounding and growing. And of course, context is everything. When you filter by age, the numbers change dramatically. A household under 35 has a median net worth of just $39,000. This really shows that that single national median is a pretty poor benchmark without understanding where someone is in their financial life cycle. And here is the really revealing truth. For the average household, once you factor in inflation, the real growth of that net worth is surprisingly slow. It's not some powerful engine of wealth creation. For a lot of people, it's more like a treadmill they have to run on just to keep pace. So if net worth is a flawed metric, then what's the alternative? Well, this is where we need to shift our thinking from our financial location to our financial velocity, and that builds a much more accurate picture. Financial trajectory is all about your momentum. It's not a static number, it's the rate of change. It answers the most important question of all. Is your financial life accelerating, stalling out, or even moving in reverse? The difference here is absolutely fundamental. Net worth tells you your location, kind of like a raft just floating in the ocean. Trajectory, on the other hand, tells you your velocity, like an airplane moving with purpose toward a specific destination. One describes where you are, the other predicts where you will end up. Let's make this really concrete. Consider two people, both with a net worth of $200,000. Person A got there mostly through a housing boom. You could call that growth by accident. But person B got there through years of disciplined contributions. That's growth by design. Their present location is exactly the same, but their systems and therefore their futures are entirely different. This timeline really shows you the power of trajectory. Over 10 years, person A's stagnant system leads to pretty minimal growth, but person B's accelerating system, which is built on compounding, results in an exponentially better outcome. Their initial net worth was identical, but the trajectory made all the difference. Okay, so how do we actually measure our own trajectory? It's not about checking your account balances every day. It's about evaluating the underlying systems that are driving your growth. There are really three key indicators you want to monitor. First, your savings rate. Is it consistent and is it growing? Second, your asset allocation. Are your assets in productive vehicles or are they in things that depreciate? And finally, the most important signal of all, the gap between your income and your spending. This right here, this is the engine of wealth creation. A positive trajectory is defined by a consistently widening gap between what you earn and what you spend, with that difference being systematically invested. This is momentum in its purest form. So ultimately, this requires a fundamental shift in what we track. Instead of obsessing over the scoreboard, we need to focus on the performance of the engine itself.
Now, to be clear, net worth isn't useless. It's a valuable indicator to check periodically, maybe once or twice a year, just to confirm your general direction. But it should never be the primary gauge you use to navigate your financial life day to day.
So, to sum it all up, think of your financial life as a motion picture, not a single photo. Concentrate on building robust systems for saving and for allocating capital. A strong trajectory creates durable security because it's powered by the deliberate systems of consistency and compounding.
That's the real question, isn't it? It's not about the number on a screen today. It's about the slope of your progress over time. Because that slope, your financial trajectory, is what will ultimately determine your destination.